We will tell you the 15 mistakes that are keeping you poor. You will get shocked after knowing these mistakes, as these are very common. So watch this video till the end. Now let's start. Number 1. Spending more than you earn. One of the most significant errors individuals often encounter is exceeding their income with their expenditures. While it may be tempting to use credit cards or loans for purchases, consistently exceeding your income can lead to significant debt accumulation. To mitigate this risk, it's essential to establish a budget and adhere to it consistently. It's essential to live within your means and aim to set aside a portion of your income each month for future needs. Number 2. Not having a fund for unexpected expenses. Challenges that are not anticipated might often arise in life. Unanticipated occurrences, such as unexpected medical crises, auto repairs, or job losses, might occur at any time you least expect them to. If you do not have an emergency fund, you can find yourself relying on credit cards or loans to handle unanticipated needs. This might lead to the accumulation of further debt at your expense. Your objective should be to save enough money to cover your living costs for 3 to 6 months in an account that is easily accessible. Now, subscribe to our channel and also press the like button to know mistakes that are keeping you poor. Number 3. Not taking control of your credit card debt. Credit cards, despite the fact that they provide convenience, may expose users to hazards if they are not managed with caution. By keeping a balance on your credit card, you run the risk of incurring higher interest rates, which might drastically extend the length of time you are in debt. For optimal results, it is recommended that you pay off the whole sum on your credit card every month. If you want to improve your financial security, it is recommended that you make paying off any present debt your first priority. Number 4. Ignoring your credit score as a consideration. Your ability to borrow money and the interest rates you will be charged are both heavily influenced by your credit score, which plays a significant part in both calculations. It is possible for a poor credit score to result in severe financial implications, including the accumulation of extra interest payments up to thousands of dollars over the course of the loan's lifetime. Keeping your credit card balances low, making sure that your payments are paid on time, and reviewing your credit report on a regular basis are all very important things to do. Number 5. The failure to make preparations for future investments. There are a lot of people who are reluctant to invest because they are afraid of the potential for loss, or because they do not have enough knowledge about how the process works. It is possible that, over time, increased costs may result from a failure to invest. Due to the effects of inflation, the buying power of money decreases throughout the course of certain time periods. When it comes to accumulating wealth and preserving your buying power in the face of inflation, assigning your resources to real estate, bonds, or stocks may be an efficient method. Make sure to start with measures that are reasonable, work on improving your knowledge, and consider seeking the advice of a financial expert whenever possible. Number 6. Failing to identify and establish financial goals. The establishment of distinct financial goals is of utmost importance since it assists in preventing spending that are not essential on things that are pointless. Your ability to concentrate and be motivated may be improved by setting goals that are both specific and measurable. Whether it's for a house, retirement, or a vacation, setting a financial goal gives you a direct objective to work towards and improves your ability to make well-informed decisions about your finances. Number 7. Lack of preparation for retirement by not setting up funds. Starting your savings earlier rather than later will greatly improve your financial stability, even if retirement may seem like a somewhat distant prospect. Delaying the beginning of one's retirement savings is a typical practice among people which might result in the loss of chances to benefit from compound interest. Think about enrolling in a retirement plan that is provided by your company, such as a 401k, or starting an individual retirement account, IRA. It is possible for even very small investments to increase in value significantly over the course of time. Number 8. Impulse purchasing. It can be quite tempting to make impulsive purchases, particularly in the realm of online shopping. Impulse buying can rapidly deplete your financial resources. Prior to making a purchase, consider whether it is a necessity or merely a desire. Consider implementing a 24-hour waiting period before making a purchase to evaluate whether the desire for the item persists. Number 9. Failing to establish a budget. The budget serves as a crucial instrument for effectively overseeing your financial situation. Establishing a budget is essential for tracking your expenditures and preventing overspending. Monitor your monthly income and expenditures, and establish a budget that enables you to maintain financial stability while also setting aside savings for future needs. Number 10. Overlooking inflation. Inflation refers to the increase in prices over time, indicating that the purchasing power of your money may diminish in the future. It's important to consider that if your savings are placed in a low-interest account, they may struggle to outpace inflation. It may be beneficial to explore investment opportunities that provide greater returns, such as equities or real estate, to enhance the growth of your capital beyond the rate of inflation. Number 11. Failing to compare offers. Numerous individuals tend to overspend due to a lack of effort in comparing options for the most advantageous offers. Evaluating your options for insurance, utilities, and groceries can lead to significant savings. It's essential to invest time in comparing prices to maximize your financial efficiency. Consider utilizing price comparison platforms, seek out available discounts, and feel empowered to engage in negotiations. Number 12. Overdependence on a single income stream. Relying on a single source of income may expose you to potential financial vulnerabilities. In the event of job loss or business failure, you may encounter a significant financial challenge. It may be beneficial to explore opportunities for diversifying your income streams, such as initiating a side hustle, investing in real estate, or identifying alternative methods to generate revenue. Diversifying your income sources can enhance your financial stability and contribute to wealth accumulation. Number 13. Failing to acquire financial knowledge. Understanding financial principles is essential for effective money management. A significant number of individuals often struggle with making sound financial choices due to a lack of understanding of fundamental concepts such as interest rates, investments, and taxes. Invest time in enhancing your understanding of financial management. Consider exploring literature, enrolling in educational programs, or consulting with a financial expert. Number 14. Excessive housing expenses. For many individuals, housing typically represents the largest financial obligation. It is important to recognize that many individuals tend to spend more than necessary on their housing, whether through purchasing or renting, which can significantly limit their ability to allocate funds towards savings or investments. It may be beneficial to evaluate the option of downsizing, relocating to a more affordable area, or renting out a room. These strategies can help lower your housing expenses and increase your capacity to save. Number 15. Delaying financial decisions. There are a lot of people who put off making important decisions about their finances, such as when it comes to retirement planning, creating a budget, or dealing with debt repayment. There may be serious long-term repercussions resulting from delaying your financial choices. You are putting yourself in a position to take advantage of larger advantages in the future by taking action right now to efficiently manage your funds. The first step towards improving your financial situation is to start making progress right away, even if it's only a little one. Now, watch the video appearing on the left side to know the investments that will make you rich. I have also discussed about my favorite investment in this video. Also, subscribe to our channel to know more financial tips and secrets daily.